2. Segregated funds. Segregated funds are an investment that is exclusively created by life insurance companies. Their key characteristics have been introduced in Chapter 1 and will now be examined more closely. Segregated funds are offered through an insurance contract and they come with guarantees that protect their value. They are a suitable investment for those who want investment income or growth through exposure to the financial markets and yet want to limit risk. Segregated funds are an alternative to other fund investing and they provide many advantages to their investors. 2.1 Advantages of segregated funds. The following advantages of segregated funds are discussed in the next pages. Black small square guarantees, black small square growth secured by reset, black small square funding flexibility through ongoing deposits, black small square ease of monitoring value, black small square guaranteed income, black small square professional management, black small square diversification, black small square tax benefits, black small square switches between funds, black small square ability to withdraw redemption, black small square exemption from probate fees, black small square investor protection, black small square protection from creditors, black small square absence of medical underwriting, black small square right of rescission. 2.1.1 Guarantees. Segregated funds provide two guarantees that protect the investor from the loss of principal, a maturity guarantee and a death benefit guarantee. The maturity guarantee applies on the maturity date of the contract. The minimum maturity date is 10 years, never less, from the time the first deposit, or premium, is paid to the insurer, although some contracts offer maturity dates much longer than 10 years. A contract never matures before 10 years. The maturity guarantee ensures that, on the maturity date, an amount that is equal to at least 75% of the amount the policy owner deposited to the contract is paid out. The death benefit guarantee applies throughout the entire term of the contract. It applies whenever the annuitant dies during the contract, and is equal to, at least, 75% of the sum deposited to the contract. Withdrawals from the contract reduce the sum on which the guarantees are calculated. The minimum guarantee percentages, 75%/75%, remain the same, and they are applied to the lower balance of the contract after the withdrawal is made. To best understand the guarantees, it is important to understand the roles of the parties to the contract. There are three parties. Black small square. The first party is the person whose money, the principal, is deposited to the contract. This is the policy owner. He makes the investment decisions pertaining to the contract. He may also make withdrawals. The policy owner receives the policy proceeds when the contract matures and, therefore, is the person who benefits from the maturity guarantee. Black small square. The second party to the contract is the annuitant. If the policy owner buys the segregated fund contract in an RRSP or a RRIF, the policy owner must be the annuitant of the policy. If the policy owner buys the contract in a non-registered, also called a taxable, account, the annuitant can be any person named by the policy owner. The annuitant is the person on whose life the death benefit is based. Black small square. The beneficiary is the third party to the contract. The policy owner names the beneficiary of the contract. If the annuitant dies, the beneficiary receives an amount that is equal to, at least, 75% of the initial deposit. Therefore, the beneficiary benefits from the death benefit guarantee. The minimum maturity guarantee and death benefit guarantee is 75% of deposits based on a 10-year term to maturity. Some contracts are structured to offer 100% guarantees. Often these contracts are based on a longer term to maturity, such as 15 years. Some segregated funds extend the maturity date to age 100 of the policy owner. Maturity and death benefit guarantees may be equal, 75% per 75%, or the maturity guarantee may be less than the death benefit guarantee, 75% per 100%. If the value of the contract at maturity or death is less than the guarantee, the insurer makes up the difference so that the amount paid out is equal to the guarantee. This is often referred to as a top-up. The life insurance agent assists the investor to choose a contract that provides the guarantees, and term to maturity most suitable to his needs and objectives. The key pieces of information needed to understand how the maturity and death benefit guarantees apply and when they are paid are: black small square, what is the value of the principal or premium invested by the policy owner in the segregated fund? This is the sum on which the guarantee is based. Black small square, what is the guarantee? 75% or 100%. This percentage is applied to the principal and determines the amount received on maturity and on death. Black small square, what is the market value of the contract at maturity or death? 8. This is the sum that dictates whether a top-up is needed to equal the guarantee. 2.1.1.1 Maturity Guarantee. As previously mentioned, segregated funds are issued as an insurance contract with a minimum 10-year term to maturity. Some funds have a longer term to maturity, but none are shorter than 10 years. The maturity guarantee gives the policy owner the peace of mind of knowing that, no matter how the fund performs, the sum he will receive at maturity will be at least 75% of the amount he invested. This provides what is known as downside protection. It limits investment risk by establishing a minimum contract value payable at maturity. However, there is no maximum to what the value may be. This is called unlimited upside potential. On maturity of the contract, the policy owner has two options. He may withdraw the value of his investment, or he may extend the contract and leave his investment in place. In either case, the insurer determines the market value of the contract and compares that sum against the contract maturity guarantee. Black small square, if the market value is greater than the guarantee value, the policy owner receives the market value. Black small square, if the market value is less than the guarantee value, the policy owner receives the guarantee value. Therefore, on maturity, the policy owner never receives less than the maturity guarantee, as illustrated by Table 2.1. 8. The market value is the worth of the segregated fund units held by the policy owner at a point in time. Market value is determined as unit value x number of units owned. Valuation will be explained later in this chapter. Table 2.1. Determining value received at maturity. Market value of contract at maturity, amount received by policy owner. Higher than guarantee value, market value. Lower than guarantee value, guarantee value. When the market value is less than the guarantee value, the insurer makes up the difference between the market value and the guarantee from its financial reserves. In effect, the insurer tops up the market value to equal the value of the maturity guarantee. This top-up is paid to the policy owner in cash if the contract is terminated. If the contract is extended, the top-up is attributed to the account so that the value of the maturity guarantee may remain the same moving forward. The maturity guarantee applies only on the maturity date of the contract. Therefore, if a policy owner withdraws some units before the contract matures, he receives the market value of the units at that time. If the withdrawal is made during the period the sales charge applies, the applicable charges will be deducted from the withdrawal. The market value of the units may be greater than, equal to, or less than the value of the units when the deposit was made. There is no guarantee in regard to their value when surrendered. A partial withdrawal or full contract surrender before the maturity date does not receive the benefit of the maturity guarantee. As mentioned previously, withdrawals reduce the sum protected by the guarantees, but do not change the percentages of the guarantees. Example: Michael invests $10,000 in a segregated fund with a 75% maturity guarantee. The guarantee at maturity is $7,500, $10,000 times 75%. Scenario 1: At maturity, the fund has a market value of $8,360. This is greater than the maturity guarantee, and it is the sum Michael receives. Scenario 2: At maturity, the fund has a market value of $6,360. This is less than the maturity guarantee. Michael receives $7,500, which comprises the market value plus a guarantee top-up of $1,140, $7,500 to $6,360. Scenario 3. After 4 years, Michael surrenders the contract. The fund has a market value of $7,120, and this is the sum Michael receives. Michael does not receive the benefit of the maturity guarantee because he has surrendered the contract before its maturity date. 2.1.1.2 Death Benefit Guarantee. The death benefit guarantee is a promise made by the insurer that the beneficiary of the segregated fund contract will receive at least 75% of the sum deposited to the contract if the annuitant of the contract dies during the term of the contract. Up to 100% may be paid. This percentage is set out in the contract. The death benefit is received by the beneficiary. The guarantee, whether 75% or 100%, is a minimum. The amount paid to the beneficiary as the death benefit is calculated the same way the maturity guarantee is calculated. It is based on the amount deposited to the contract, its market value at the time of death, and the death benefit guarantee under the contract. The beneficiary receives the greater of market value or the death benefit guarantee. If the market value is less than the guarantee, the insurer makes up the difference between the two amounts. Similar to the maturity guarantee, the amount contributed by the insurer may be referred to as a top-up, because the insurer tops up the lesser value in order to fulfill its contractual promise. There are 4 advantages to the death benefit guarantee. Black small square. The beneficiary is protected from fund losses throughout the term of the contract, just like the maturity guarantee protects the policy owner. Black small square. The guarantee applies from day 1 of the contract. Segregated funds are a long-term investment, but if there is a drop in market value in the short term and death occurs, the decrease in value is accommodated by the guarantee. Black small square. Segregated funds do not require medical underwriting. Therefore, an older person or a person in ill health does not need to be concerned about poor market conditions at the time of his death. The guarantee gives him peace of mind that his beneficiary will receive at least 75% of deposits. Black small square. Like the maturity guarantee, there is no upper limit to how much the beneficiary might receive if market conditions are favorable and unit values are high at the time of death. The death benefit may also be reduced by a sales charge. Some insurers waive these charges when the contract ends due to death. The value of the investment is further enhanced because it will not be subject to probate fees if there is a named beneficiary that is not the estate of the deceased. Segregated Funds and Annuities. Chapter 2. Segregated Funds. 57. Example. Keith is the policy owner and annuitant of a segregated fund contract with a 75% death benefit guarantee. Keith funded the contract with a $10,000 bonus he received from his employer. The death benefit guarantee is, therefore, $7,500, $10,000 times 75%. His wife, Patricia, is the beneficiary of the contract. Keith dies during the 9th year of the contract. Scenario 1. At the time of Keith's death, the market value of the contract is $12,640. Patricia receives that amount since it is greater than the death benefit guarantee of $7,500. Scenario 2. At the time of Keith's death, the market value of the contract is $6,300, which is less than the guaranteed amount, $7,500. Patricia receives the death benefit guarantee of $7,500, which represents the market value of $6,300 plus a top-up of $1,200, $7,500 to $6,300. 2.1.2 Growth secured by reset. Market values of fund units go up and down. There is no predicting when values might change or by how much. All fund investors hope to see their units continually rise in value. Segregated funds are unique in that they offer investors a chance to lock in an increase in value during the term of the contract in a process known as reset. So, when the value of the contract rises due to fund performance, the investor can set the contract value at that higher level. Doing so has the effects of increasing the maturity and death benefit guarantees, and changing the contract's maturity date. Both the policy owner, through the maturity guarantee, and beneficiary, through the death benefit guarantee, can benefit from reset. Example. An investor deposits $20,000 in a segregated fund. The 75% maturity and death benefit guarantees are $15,000, $20,000 times 75%. If the market value increases to $50,000 in the fourth year of the contract, the guarantees will now amount to $37,500, $50,000 times 75%, if the contract is reset. Segregated Funds and Annuities Chapter 2 Segregated Funds 58. Reset also changes the maturity date of the contract. The new maturity date of the contract is 10 years from the reset date. Some insurers offer an automatic reset on segregated fund contracts, in which the insurer automatically locks in growth of the account value. Others put the decision to reset into the hands of the policy owner. Regardless of who resets the contract, the maturity date is extended when it is reset. Therefore, reset may be attractive to an investor who is oriented towards fund growth and increasing his investment returns. However, reset may not appeal to an investor who has a 10-year time horizon for his investment. Not all insurers offer reset on their segregated funds. If reset is available, and it is up to the policy owner to make the reset decision, he does not have to reset the contract because he may not want to extend its maturity date. Example: Hassan deposits $5,000 to a segregated fund contract with a 75% maturity guarantee and 75% death benefit guarantee. Each guarantee is worth $3,750. $5,000 times 75%. After 2 years, the market value of the contract is $7,000. Hassan's contract offers reset, and he chooses to reset the contract. This increases the maturity and death benefit guarantees to $5,250, $7,000 times 75%, and resets the maturity date of the contract. His contract now matures 10 years from the reset date, 12 years from the time of the initial deposit. There may be limitations to reset, such as an additional fee charged annually to contracts in which reset is permitted. Also, an insurer may offer reset on the maturity guarantee separately from the death benefit guarantee. If so, the investor could choose to reset the maturity guarantee, but not the death benefit guarantee, or vice versa. The insurer provides information regarding the number of resets allowed and the mechanisms to request or accept a reset in the information folder provided at the time of sale of the fund. 2.1.3 Funding flexibility through ongoing deposits. The principal deposited to a segregated fund contract is called the deposit or premium. It can be contributed as a lump sum or as a series of deposits. When a series of deposits is made, the maturity guarantee may be applied to the individual deposit dates or to the date of the contract. Most commonly, the guarantee is based on the deposit date or dates. Each deposit has its own maturity guarantee of 75% or 100% of deposit value, the length of which is based on the term to maturity in the contract, 10 years or more. Therefore, Deposit 1 has a maturity guarantee that applies from its deposit date, Deposit 2 has a maturity guarantee from its deposit date, Deposit 3 has a maturity guarantee from its deposit date, and so on. Sandra has a deposit date-based segregated fund with a 10-year term to maturity. She deposits $2,000 as an initial deposit, and then $2,000 every year thereafter on January 1st for 2 years for a total of 3 separate deposits. At the start of her contract, her maturity guarantee is $1,500, 1 times, $2,000 times 75%, in 10 years. At the end of 11 years, her maturity guarantee is $3,000, 2 times, $2,000 times 75%. At the end of 12 years, her maturity guarantee is $4,500, 3 times, $2,000 times 75%. 2.1 Point for ease of monitoring value. An investment in a segregated fund provides the investor with an assigned number of units. The number of units assigned at the time of purchase is a result of how much is invested and their fair market value. Every fund has its own unit value. This is also true of mutual funds. It is essential for the investor to know the value of units when they are assigned if he wishes to follow performance and monitor changes in value. An increase may indicate that a reset is in order. A decrease could suggest a fund switch is in order. Example: an investor invests $1,000 in ZYX fund, in which units have a market value of $10. He is assigned 100 units, $1,000 divided by $10. If the market value of the units increases to $12, his investment will be valued at $1,200, $12 times 100. A unit value is determined for each fund. The value is called the NAVPU or net asset value per unit. The term NAV, or net asset value, is also used. It is calculated as NAVPU equals total value of assets, liabilities. Number of units outstanding. The NAVPU is determined on each valuation day. For a fund investing in Canadian equities, a valuation day is a day that the Toronto Stock Exchange is open. Therefore, if a valuation shows an increase in NAVPU, the market value of the investment has increased. Unit values increase and decrease in step with the value of assets held within the fund. However, the number of units assigned to the investor does not change unless he makes an additional deposit. In other words, he buys more units, or a withdrawal by selling units. Allocations are another way an investor benefits financially from his segregated fund. Segregated funds allocate taxable income and realize capital gains and/or losses to non-registered contract owners. Investment growth in a fund is generated in the form of interest, dividends, and capital gains. These earnings are not distributed to investors in the form of cash. Instead, the allocations change the adjusted cost base of the units, but not their NAV. Interest, dividends, and capital gains increase the ACB. Capital losses decrease the ACB. The change to the ACB is tracked by the insurance company. If an investor wants cash from the fund, he must make a withdrawal by redeeming fund units. 2.1.5 Guaranteed income. A segregated fund contract typically returns its value on maturity in a lump sum payment. Alternatively, a contract may create a guaranteed stream of payments. This feature may be added to an existing contract or be part of the conditions upon issue. Such a contract is available in two forms: the Guaranteed Minimum Withdrawal Benefit, GMWB, and the Guaranteed Lifetime Withdrawal Benefit, GLWB. Like all segregated fund contracts, these withdrawal benefit plans provide a maturity and death benefit guarantee. They are differentiated by the regular payments they provide, which is often compared to income because of the regularity with which the payments are made. This is one reason that withdrawal benefit plans are attractive to retirees. Not all insurers offer contracts that can provide regular withdrawal benefits. Also, there are many features, options, and restrictions that differ between these plans as offered by different insurers. Due to their complex rules and requirements, they may not be suitable for all investors who seek income. 2.1.5.1 Guaranteed Minimum Withdrawal Benefit, GMWB, and Guaranteed Lifetime Withdrawal Benefit, GLWB. Both the GMWB and GLWB plans are based on an initial deposit or deposits by an investor to a segregated fund contract. The GMWB provides a regular income over a set period of time. The GLWB pays income for life. Investors may begin making withdrawals immediately after entering into a contract, or they may choose to wait before starting to make withdrawals. Those who wait have two phases to their plans: a savings phase and a payout phase. The savings phase is a period of accumulation. During the savings phase, investors receive the potential for increase in fund market value. They also earn a credit every year in which a withdrawal is not made. The credit is based on a percentage of the initial deposit. For instance, the credit may be 5%. The value of the initial deposit plus the annual credits form a base on which a guaranteed minimum withdrawal is based. Any withdrawals during the savings phase reduce the value of the initial deposit, and thus of the corresponding credits and final guaranteed minimum withdrawal amount. The payout phase starts when regular withdrawals begin. During the payout phase, the investor receives an annual income based on the guaranteed minimum withdrawal balance created during the savings phase. As withdrawals are made, the value of the contract declines. However, the annual income guarantee is not affected. It is also insulated against poor market performance of the fund, so that the same annual income is received even if the market value decreases. Extra withdrawals can be made that exceed the guaranteed income payment. They may be penalized with fees and, like all withdrawals, reduce the base used to determine future guaranteed income. The payout value may be reset every 3 years. Reset creates a potential for increased income if the market value of the contract has increased, provided additional withdrawals have not been made. The payout also increases if more premiums are contributed after the initial deposit. The amount received is based on the payout beginning at a specified age and lasting for either a specific period of time, such as 20 years or for life. A lifetime payout will be at a lower rate than if income is taken for a specified period because the contract value is stretched over a potentially longer time. This is similar to the payment made from a life annuity compared to a term annuity. One of the risks faced by retirees is the risk that they might outlive their financial resources. This is called longevity risk. Lifetime income appeals to those with this concern, and is why individuals buy guaranteed lifetime withdrawal plans and life annuities. Both products address longevity risk. 2.1.6 Professional Management. Segregated funds employ professional investment managers to provide investment management and advice. These managers are compensated by fees, which are part of the management expense ratio, MER, charged against fund assets to investors. The investment managers are hired by the insurance company offering the segregated fund or funds. The insurer retains the right to appoint or change a manager. A management change is reported to investors. The fund manager is a highly educated and well-trained investment professional. The average investor has neither the time nor the expertise to compete with the typical fund manager. By leaving investment decisions in the hands of the fund manager, the average investor can achieve his investment objectives without having to be actively involved in the day-to-day management of his investments, thereby eliminating the obligation to make ongoing decisions. This never alleviates the life insurance agent's responsibility to work with the client to ensure his objectives are being met in the fund investment. The agent must be prepared for regular client meetings in which performance and other factors about the fund will be discussed. 2.1.7 Diversification. Segregated funds are highly diversified investments. This means their managers use a wide range of investments suitable to the type of fund. For example, an equity fund is highly diversified because it holds shares of many companies. Diversification is a key to investing success. It lessens risk for the average investor since risk is spread over all the investments held in the fund. And even in the unlikely event that all diversified assets in a segregated fund were to lose all their value, the segregated fund investor would be protected to a maximum loss by his maturity and death benefit guarantee. 2.1.8 Tax Benefits. Segregated fund investing offers several tax advantages compared to mutual funds. The ACB of a segregated fund is tracked by its insurer, and there is virtually no possibility for error. This simplifies annual tax reporting, unlike a mutual fund in which the investor must take responsibility for reporting transactions. The interest, dividends, and capital gains earned in a fund are reinvested in that fund. They increase unit value and increase the investor's adjusted cost base, ACB, per unit. The ACB is a calculation that determines the tax cost of an investment to its investor. Increasing the ACB reduces tax when the units are sold. The investor with a non-registered account receives the earnings on a flow-through basis. This means interest earned in the fund is reported for tax purposes to the investor as interest, dividends earned are reported as dividends, and capital gains and losses earned are reported as such. Capital losses are used to reduce capital gains in the year in which the loss occurs. If a loss cannot be fully used in that year, it can be carried back to the 3 previous years or forward indefinitely. This gives the investor the ability to choose when to claim his capital loss. Finally, but not to be overlooked, is that proceeds of segregated fund death benefits are probate-free when a beneficiary is named. Probate, though not precisely a tax, operates as a tax on the value of an estate remaining after death. Example: Henry invests $1,000 in www Seg Fund Series B on September 1st in his non-registered account. He is assigned 200 units on the basis that each unit is worth $5. $1,000 divided by $5 equals 200. At the end of the year, a $100 allocation is made to Henry's policy, and the unit value is fixed at $6 due to fund growth. Henry now has 200 units worth $1,200 and each unit is worth $6, $1,200 divided by 200. The ACB of Henry's policy is now $1,100, the initial $1,000 investment plus the $100 allocation. The $100 allocation Henry received is reported on a tax slip issued by the insurer to Henry as $50 in interest and $50 in capital gain. The interest is taxed at Henry's marginal tax rate. The capital gain is also taxed at his marginal rate, but only 50% of the gain is taxable. $50 times 50% equals $25. If Henry's marginal tax rate is 36%, he pays $18 tax on the interest he receives. $50 times 36% equals $18. He pays $9 income tax on the capital gain. $25 times 36% equals $9. 2.1.9 Switches between funds. A lot can happen to an investor during the term to maturity of a segregated fund. He can become more risk-averse or more risk-tolerant. He can become frustrated with performance that is lower than expected or dissatisfied with a high MER. Switching from one fund to another may alleviate investor concern, and a new fund may better suit his objectives. Whatever the reason, the investor who wants to switch his account value from one fund to another may do so with a segregated fund investment, aided by the life insurance agent who recommended the fund investment. The investor who contemplates a switch must be provided with the same information documents for the new fund as were received at the initial purchase before the switch occurs. This includes both the information folder and fund facts for the new fund. When the switch is being made, the value of the existing fund units is determined on the valuation date, which is either the day of the switch request or the following day. This is the sum that will be used to acquire units in the new fund. There is typically a minimum amount that can be transferred. Contract guarantees are not affected by fund switches. The number of switches the investor may make per year without incurring a switching fee may be limited. Individual funds state their switching policy in the information folder provided to the investor. An investor may incur a tax liability when a switch is made. An investor who switches funds where each fund charges the same load, e.g. a front-end load, FEL, will not incur a fee for the switch. However, there may be a fee for switching between funds with dissimilar loads, e.g. a no-load fund to an FEL. The insurer will state their policy for fees on switches in the information folder of the fund. February 1, 10 Ability to withdraw, redemption. The investor enters into the segregated fund contract with the intention of seeing the contract mature in at least 10 years, i.e., the term of the contract. However, his financial circumstances can change during this period, and he may find he needs to make a withdrawal from the contract to receive cash in hand. A withdrawal is also known as redemption. The investor may make a withdrawal at any time. This provides him with investment flexibility. The withdrawal process begins by the investor informing the insurer that issued the fund contract of the amount he wishes to withdraw. The investor redeems the number of units that will provide the desired sum of money based on their market value. The market value is determined at the valuation day following the request. The investor receives the money from the insurer within days of the valuation date. The maturity guarantee and death benefit guarantee of the contract are reduced as a result of the withdrawal because the investor has fewer fund units. The insurer calculates the new guarantees according to the terms of the contract. A withdrawal may trigger tax. The contract owner receives a tax reporting slip from the insurer so that the withdrawal may be taken into consideration in the tax return for that year. February 1, 11 exemption from probate fees. Probate is the process in which the will of a deceased person is proven to be valid and the person appointed as executor of the will is accepted. It occurs in the provincial home court of the deceased and is finalized when letters probate or an equivalent document is issued. Probate fees are a charge by the province or territory against the value of a deceased's estate. Only Quebec does not charge probate fees. There are great differences between both how much each province charges as the probate fee and what assets are included in the estate for the purpose of probate. Probate fees must be paid by the estate of the deceased before any property can be inherited as specified in the will. They can significantly reduce estate value in a province, such as B.E.S, that does not put an upper-end cap on probate fees. Some exceptions apply to the requirement to pay probate. Probate fees are not charged to trusts or when a surviving spouse inherits assets. Probate fees also do not apply when the beneficiary of a segregated fund contract is not the estate. A named beneficiary receives the proceeds from the contract probate-free. This includes the spouse, parents, children and grandchildren of the contract owner or annuitant. The ability to put the proceeds into the hands of the beneficiary without going to probate is one of the single most important benefits of segregated fund ownership. Potentially thousands of dollars in probate fees can be saved. However, there will be Northwest saving if the estate is named as beneficiary. If the estate receives the proceeds, it becomes part of the total estate value and subject to probate fees. Also, segregated funds are redeemable on each valuation day. Therefore, the account value can be received by the beneficiary within days instead of the months it takes when an estate must go through probate. February 1, 12 Investor protection. A surety steps in to provide investor protection when an insurer becomes insolvent and cannot meet its financial obligation to pay guarantees. A surety facilitates a quick transfer of policies from the insolvent insurer to another insurer that has the financial capacity to honor guarantees and benefits. 2.1.12.1 Guarantee exceeds market value. A surety's protection is needed only when the guarantees of the segregated fund investment at maturity or death are higher than the market value of the fund. When market value is greater than guarantees, there is no need for a surety's participation since the market value can fund the obligation of the guarantees. A surety's guarantees a segregated fund contract owner will retain up to $60,000 or 85% of guarantees, whichever is higher. In other words, it allows a segregated fund contract owner to retain 100% of his guaranteed investment if it is equal to or smaller than $60,000. For investments valued at more than $60,000, contract owners will retain 85% of guarantees. Example: Marc has deposited $100,000 to his segregated fund account, and the contract has a 75% maturity guarantee. Therefore, Marc is guaranteed to receive $75,000 on maturity. When his insurer is unable to pay the maturity guarantee due to insolvency, a surety's coverage is applied. Marc is going to receive the greater of $60,000, or $75,000 times 85%, $63,750. Therefore, Marc receives $63,750 since it is greater than $60,000. February 1, 13 Creditor protection. A creditor is a person or business to whom money is owed by a borrower, i.e., if I loan money to you, I am your creditor. A creditor may make a court claim for money owed if the borrower fails to make good on repayment. Segregated funds provide the potential for protecting contract owners from the claims of creditors. In other words, if the segregated fund policy owner owes someone money, that person cannot claim the value of the segregated fund to repay the debt. Segregated funds provide this protection because they are insurance contracts and claims are not successful if the spouse, parent, children or grandchildren are named as beneficiary in the contract, if the beneficiary is irrevocable, or if the account is a registered account. A person must not, however, try to avoid creditor claims by investing in a segregated fund. For this reason, it is necessary for the segregated fund contract to be acquired for the purpose of investment, not for the purpose of avoiding creditors. February 1, 14 Absence of medical underwriting. There is no medical underwriting of an application for a segregated fund contract. This means that the health of the contract's policy owner or annuitant is not assessed because guarantees are based on the strength of the investment and not a person's life. It makes no difference to the contract if the policy owner or annuitant has a health condition or shortened life expectancy at the time of application. If the policy owner or annuitant dies during the contract, the death benefit guarantee ensures the beneficiary receives the guaranteed minimum payment. Therefore, a policy owner or annuitant does not need to be concerned about the risk that he may die at a time when the contract has temporarily lost value. His beneficiary will receive the greater of the guaranteed proceeds, or the market value of the contract. February 1, 15 Right of rescission. The right to cancel a contract is known as the right of rescission. All insurance contracts provide this right. An investor may cancel or rescind the segregated fund contract in writing within the specific time limitation set by the insurer providing the contract. 2 days is the usual length of time permitted. The investor receives the lesser of the amount of premium paid or value of fund units on that date if it is a valuation date. If it is not a valuation date, then the value on the next valuation date applies. 2.2 Types of segregated funds. There are numerous segregated funds offered to investors. As stated in Chapter 1, the Canadian Investment Fund Standards Committee, CIFSC, classifies all fund investments into categories by asset class. Its 5 asset classes are: Black small square cash, Black small square fixed income, Black small square equity, Black small square commodity, Black small square other. This is a helpful starting point to understand the many types of funds, since each class shares certain characteristics. Also, many funds have subcategories that narrow their investment objective. Analysis of fund holdings and quick facts in the fund facts document tell the bottom line about objectives and suitability. Segregated funds. However, the actual names of funds often bear little relationship to the asset classes and categories defined by CIFSC. For instance, a fund called a creative portfolio does not reveal its asset class in its name. The agent must dig into details about top investment holdings in the fund to better understand how the fund may be classified, so that comparisons against similar funds will be accurate. Proper classification is important so that funds can be correctly compared and aligned with investor risk tolerance. For instance, if an investor has a low tolerance for risk, then he will not be suited for a fund classed as an equity fund. His better choice will be a lower risk fund, such as a bond fund invested in government bonds. Each fund is highly diversified. Top holdings are described in the fund facts document or information folder. Other holdings for each fund may be too numerous to list. 2.2.1 Money market funds. Money market funds must invest at least 95% of their total net assets in cash or cash equivalents, such as Government of Canada short-term bonds or Treasury bills. 9. Money market funds are the lowest risk funds and correspondingly have a low rate of return. 2.2.2 Bond funds. Bond funds are a fixed income type of fund. These funds must invest a specified percentage of their holdings in fixed income securities, such as bonds and treasury bills. Fixed income funds may be categorized according to the duration of the bonds held by the fund. For instance, the bonds in a short-term bond fund mature in less than 3.5 years. Bonds in a medium-term fund mature between 3.5 and 9.0 years, and bonds in a long-term bond fund mature in 9.0 years or longer. Fixed income funds are described in the currency of the security held in the fund, e.g. Canadian dollar-denominated securities in a fund refer to a Canadian fixed income fund. Point 10. Fixed income funds are generally low risk and have a low rate of return. Some funds may invest in securities with a lower credit rating in order to achieve a better return. These funds may be called high yield. High yield bonds are also known as junk bonds, and such funds carry much higher risk than traditional bond funds. 2.2.3 Equity funds. Equity funds are also known as growth funds. They invest in stocks of publicly traded companies and income trusts to generate dividend income and capital gains. An equity fund may be diversified across different types of businesses or concentrated in a particular sector, such as financial services. Even when focused on a specific industry sector, the fund will have many holdings in that sector and will be highly diversified. However, higher levels of risk are experienced when an equity fund is concentrated in one sector even though it will be diversified in that sector. Such a concentration means the fund is susceptible to industry risk in its sector. Fund growth is achieved when stocks held by the fund are sold at a higher price than their purchase price, and by reinvesting dividends paid on fund holdings. The increase in price is the capital gain on the stock. There is a higher degree of risk with an equity fund than with other types of funds. Stocks and stock markets are highly volatile, price swings can be significant. Company fortunes and prospects rise and fall in part due to factors that cannot be predicted, such as investor mood and sentiment. This makes the profitable buying and selling of stocks challenging for even the most experienced investment manager. This is the nature of equity risk. Example. Here is a sample list of top equity holdings for a fictional Canadian equity fund. Holdings proportion of Fund Bank of Montreal 7.02%, National Bank of Canada 5.75%, Royal Bank of Canada 5.7%, Quebecer 5.23%, BCE 4.9%, Suncor Energy 4.38%, Sun Life Financial 4.07%, Gold Corp 3.92%, Power Corporation 3.75%, Rogers Communications 3.33%. 2.2.3.1 Equity funds by market capitalization. Market capitalization, or CAP, is a category of equity funds that give an investor the opportunity of fine-tuning their risk level to company size. The larger the market capitalization, generally the lower the investing risk. The cap is simply a range that shows how large a company is. Large cap funds, mid cap funds, and small cap funds are the most common. However, there are also mega caps, $200 billion plus, micro caps, $50 to $300 million, and nano caps, less than $50 million, 11. For example, Shopify is a large cap company with a market cap of $168 billion, May 2021. Gozi is a medium cap company with a market cap of $2.16 billion, May 2021. 2.2 For income funds. Income funds are based on bonds, and growth is derived by the regular interest income the bonds pay, and their possibility for capital appreciation. Some income funds may also hold high-quality stocks. When stocks are included in the income fund portfolio, the unit owner may receive both dividends and capital gains from his investment. Both government and corporate bonds may be held in income funds. Income funds are a lower risk fund. 2.2.5 Balanced funds. As the name suggests, balanced funds aim to strike a balance in their case between stocks and the growth potential they represent, and fixed income and the safety the category represents. So, to attain the balance illustrated in Diagram 2.1, these funds invest in stocks and bonds. Diagram 2.1. Investing in balanced funds. Balanced funds are also known as balanced growth or balanced income funds. A balanced growth fund emphasizes stocks. A balanced income fund emphasizes bonds. The risk associated with these funds depends on how the balance is weighted. Stocks are higher risk, bonds are lower. When there is an even split, risk is averaged out. Balance funds suit an investor who wants some exposure to stocks, but is not prepared for the volatility of stocks alone. Example. Here is a sample list of top holdings in bonds and stocks for a fictional balanced fund. Holdings proportion of fund Government of Canada bond 4.25%, Canada Housing Trust bond 3.98%, Royal Bank of Canada 3.85%, Potash Corp 3.43%, Province of Ontario bond 3.35%, Bank of Montreal 2.99%, CIBC 2.86%, BCE 2.79%, TD Bank 2.55%, Province of Quebec bond 2.24%. 2.2.6 Target date funds. A target date fund combines equity and fixed income investments. Its objective is to decrease risk over time. At the time of the investment, the investor picks a target date, usually the date he intends to retire, but it can be any date or any age. Over the duration of the investment, the asset allocation gradually and automatically shifts from a higher to a lower level of risk as equities, such as stocks, are replaced with fixed income products, such as bonds. It is not uncommon for risk tolerance to decrease with age because later in life an investor generally has very limited ability to make up for investment losses. Therefore, a target date fund is a good choice to see an investor into retirement and beyond. Target date funds are often a default option for anyone who is in a pension plan, and they are a popular choice among less sophisticated investors thanks to their easy-to-understand concept. 2.2.7 Dividend funds. A dividend fund invests in companies that have a history of paying dividends. A dividend is a distribution of a percentage of company profits by the board of directors to company shareholders. They are not guaranteed, but the obligation to meet dividend payments is taken very seriously by a company and its investors. Dividends received from Canadian corporations are taxed at a lower rate than interest income as a result of the dividend tax credit. This increases investor appeal. A dividend fund may also invest partly in bonds. Dividend funds are considered low to medium risk. 2.2.8 Mortgage funds. A mortgage fund holds residential, commercial, and industrial mortgages. When mortgages have a higher degree of risk because the underlying assets are riskier, mortgage funds are categorized as an other asset class. Low-risk mortgage funds are a type of fixed income fund. Default risk is associated with a mortgage fund. It is experienced when mortgage holders default on, i.e. fail to make, their mortgage payments. 2.2.9 Real estate equity funds. Real estate equity funds must invest at least 90% of their assets in retail, commercial, industrial, and residential properties. 12 They earn income from mortgages and have potential for capital gains as property values increase. Real estate funds own property, mortgage funds do not. Some funds invest in real estate investment trusts, REITs, companies that, in turn, invest in real estate. The risk of each fund will be a result of the types of properties in which the fund invests and their location. Real estate funds are particularly suitable for long-term investment because property values need to be given enough time to rise in value. Real estate is an illiquid investment. In cases when real estate values are low due to market conditions, investors may not be able to exercise their redemption privileges due to the illiquid nature of the underlying investments. February 2, 10 Index funds. An index fund is a mirror of an index, such as the S&P/TSX Composite Index, that invests in the same stocks that are listed on the index. Therefore, if the index rises, the index fund will also rise. Its results will be slightly less than the actual index because of the fees that are charged to the fund. This form of investing is known as passive investing because the investment manager mimics the index chosen for his particular fund and maintains the same securities in the same weight. There are many indexes on which funds may be based. They include equities, bonds, commodities, currency, and real estate among others. The risk of a fund is a result of the underlying market the fund tracks. February 2nd, 11 Fund of funds. A fund of funds is, as its name indicates, a fund that invests in other funds. The purpose of this approach is to benefit from managerial expertise in other funds and to diversify. The fund manager decides which funds suit the portfolio based on the fund objective, and he rebalances holdings as needed to maintain the objective focus. The risk of the fund is entirely a result of the underlying funds in the portfolio and its investment objective. February 2nd, 12 Specialty funds. Some funds are created to appeal to specific investor wants and respond to investor needs. They are called specialty funds. Specialty funds do not have the mass appeal or assets of their large segregated fund cousins, such as equity funds. However, specialty fund categories such as socially responsible funds fill important investment objectives for their investors. Socially responsible funds provide an alternative for investors who, for religious, political, environmental, or moral reasons, find the holdings of standard funds unacceptable for investment. Investors seek funds that align with their investment objective, such as the investor's desire to invest in green energy. Investors are less concerned about the risk of the fund since their primary goal is to support a cause or belief. Other specialty funds include emerging markets funds or funds that seek companies that are struggling financially. Once again, there are many specialty funds to choose from. The risk of specialty funds lies with the fund's objective and investment strategy used by the fund manager. Each one should be carefully studied to determine if its risk is suitable for the investor. Here is a sample list of top holdings in stocks for a fictional socially responsible equity fund. Note that companies that produce liquor, wine, beer, cigarettes, and medical marijuana are absent from holdings. Holdings proportion of fund: Royal Bank of Canada 4.97%, Manitoba Telecom Services 4.97%, EL Financial 4.44%, Laurentian Bank 4.22%, Empire Company 2.66%, Leon's Furniture 2.65%, Apple 2.1%, Parmalat 2.05%, TD Bank 2.03%, OpenText 2.01%. 2.2.12.1 Industry-specific funds. An investment manager who has an interest in a specific industry, or the belief that an industry will flourish in the economic conditions of today or the future, may create a fund that specializes in that industry. Such industries may be well established or feature new technology, services, or products. The landscape is constantly evolving. Risk of industry-specific funds depends on the industry that forms the basis for the fund, its volatility, and its prospects. 2.2.12.2 Geographically specific funds. Certain funds focus on the investments. Black small square within a country, e.g. Canada. Black small square outside the boundaries of a country, e.g. North America. Black small square of a selection of countries, e.g. international. Black small square of a region, e.g. Asia. Black small square of part of a region, e.g. Asia except Japan. Black small square of the entire globe. Segregated funds and annuities. Chapter 2. Segregated funds. 74. Countries change in their appeal to investors over time. Some become very attractive investment opportunities while others lose their appeal. Funds with a geographical focus reflect such changes. Political volatility is a risk associated with investing outside Canada and similar developed nations. Currency risk is another. An investor who seeks foreign opportunities should be well aware of the political situation and economic stability of the country or region in which he plans to invest. He should also monitor changes that might affect the investment, example, an election. February 2nd, 13 New introductions. Funds evolve over time based on consumer interests. New funds are created for a variety of reasons, including to offer new investment opportunities or to provide new features. Funds that have lost their appeal are closed and may be amalgamated with other funds. The life insurance agent's role is to be aware of his client's needs to ensure funds, whether new or old, align with client needs, interests, and objectives. 2.3 Segregated fund limitations. Even with the guarantees offered by segregated funds and their other benefits and features, like all other investments, they also have limitations. These limitations should be as well understood as benefits to ensure all client questions and concerns can be accurately addressed. These limitations of segregated funds are detailed in the following pages: black small square risk to capital, black small square sales charge, black small square management expense, black small square penalties, black small square age restrictions for acquisition. 2.3.1 Risk to capital. The principal risk of segregated funds is that the investor could lose up to 25% of his capital when the contract provides 75% maturity and death benefit guarantees. As diagram 2.2 illustrates, even though the guarantees protect 75% of deposits, 25% remains unprotected. Diagram 2.2. Proportion of unprotected segregated fund investments. Another risk is the fixed term to maturity period of the standard contract. This makes segregated fund investing a long-term investment. If the investor needs to make a withdrawal before the contract matures, he does not receive the benefit of the maturity guarantee and receives market value for the withdrawal minus any outstanding fees and charges, such as the deferred sales charge (DSC). Risks associated with segregated fund investing depend on the types of investments held in the fund itself. For example, bonds are lower risk than equities. Therefore, a bond fund is lower risk than an equity fund. 2.3.2 Sales charge. The licensed agent works with the client in the development of the investment plan. When that plan includes a segregated fund contract, the agent spends time determining the most appropriate fund choice for the client, making a recommendation, perhaps revising the recommendation, preparing the application, delivering necessary documents, and ensuring client satisfaction. The agent may be compensated for his time, skill, and effort through a direct charge paid by investors and indirectly through a trailing commission. The charge paid by investors is called a sales charge or a load. A sales charge applied at the time of buying into a fund it is called a front-end load, FEL. When it is charged to redeem units, it is called a deferred sales charge, DSC. As noted previously, the DSC on mutual funds will be eliminated in all jurisdictions in 2022. As stated earlier, an investor who switches funds may find the load on the new fund is charged differently from the load on the existing fund. He may be required to pay a one-time fee to equalize the expense at the time of switching. Segregated funds and annuities. Chapter 2. Segregated funds. 76. 2.3.2.1 Front-end sales charge. A front-end sales charge is exactly as its name suggests, a fee charged at the beginning of the contract, known as its front end. The front-end sales charge is also called a front-end load, FEL. The fee is charged to the client as a percentage of the amount he deposits to the segregated fund contract. It reduces the sum applied to the contract and reduces the amount of investment dollars that go to work for the client. However, the client has no future fees to anticipate. Both the maturity guarantee and death benefit guarantee are based on the amount of deposit before the FEL is deducted. The amount charged as an FEL is usually negotiable between agent and client. The investor who pays an FEL pays no further sales fee if he redeems units during the term of the contract. Example: Jose has $10,000 to deposit to a segregated fund contract with an FEL of 5%, $500. The contract value therefore begins at $9,500, $10,000 to $500. The maturity and death benefit guarantees are based on the $10,000. 2.3.2.2 Deferred Sales Charge, DSC. The DSC is applied to a full or partial withdrawal made from a segregated fund during a set period of time. The charge is a percentage applied against the amount withdrawn. It declines over a number of years until it is eliminated. Each insurer has a schedule that lists the amount charged each year and the number of years the charge is applied. The schedule informs investors of what to expect as a sales charge if they proceed with a withdrawal or surrender. The DSC encourages investors to keep their investment and not to surrender the contract while the sales charge is in place. As noted previously, the DSC on mutual funds will be eliminated in all jurisdictions in 2022. Securities regulators brought forward the elimination of DSCs in the interest of Canadian consumers since many consumer complaints were based on DSCs. Mutual funds are a securities product and governed by securities legislation and therefore subject to the new DSC rule. Segregated funds are insurance contracts and are subject to provincial insurance law, not securities law. DSC redemption schedules for sales made prior to the ban will be allowed to run their course in Ontario. This means DSC charges on mutual funds could apply up until 2028 or 2029 on funds sold through 2022. Here is an example of how a DSC might appear. Length of time after premium is paid: charge less than 1 year 5%, 1, less than 2 years 4.5%, 2, less than 3 years 4%, 3, less than 4 years 3.5%, for less than 5 years 3%, 5, less than 6 years 2.5%, 6 years plus 0%. Josephine deposits $10,000 to her segregated fund contract with a DSC. 2 years later she needs some of the money. She withdraws $5,000. The sales charge applicable is 4%, according to the table above. Therefore, she pays $200, $5,000 times 4% as the DSC. 2.3.2.3 No sales charge. Segregated funds that do not have a sales charge are called no-load funds. They may compensate for the absence of a sales charge by charging a higher management expense fee. 2.3.3 Management expense. The management expense is the combination of the management fee for a fund, its operating expenses and taxes. When these expenses are added together and expressed as an annual percentage of the total value of the fund, it becomes the management expense ratio, MER. The management fee compensates the fund company for the cost of investment management by a portfolio manager, trailing commissions and fund oversight. The operating expenses include administration, legal fees, marketing and other similar costs. Tax is charged as the provincial HST rate that applies where the investor lives, and is charged on management fees and administration fees. The MER of segregated funds is typically higher than the MER for an equivalent mutual fund. The MER of a segregated fund must maintain a reserve to uphold segregated fund maturity and death benefit guarantees. This is sometimes called the insurance charge. MERs are charged whether the market value of the fund increases or loses ground. They reduce investor returns. Fund performance is reported after the MER has reduced the return. If the value of units rises by 5% in a year, and the MER is a 3% charge, the investment has actually only gained 2%, 5% to 3%, and 2% will be reported to the investor. If the unit value falls by 5% in a year, and the MER is a 3% charge, the value of the investment will actually have decreased by 8%, minus 5% to 3% equals minus 8%, and likewise the investor will be apprised of an 8% loss in the value of his investment. Higher MERs are associated with funds requiring more active management and decision-making. Low MERs are charged by funds such as index funds that require less active management and decision-making since the manager simply follows the index itself. Over time, MER expenses can significantly diminish returns. They are an important disadvantage of both segregated fund and mutual fund investing. The MER of a fund can be changed at any time by the insurer. Investors must be notified of the change. The effect of MER on returns is often underestimated by fund investors. It is essential they know what an MER increase will mean for future returns in dollars and cents, and not just on a percentage basis. This is good practice for agents and satisfies a requirement for disclosure. 2.3.3.1 Trailing Commission. A trailing commission is a sales compensation fee incorporated in the MER. It pays the agent on a continuing basis for the advice he has provided for as long as the investor holds the fund. It is calculated as a percentage of the market value of the fund. 2.3 For penalties. The segregated fund contract is provided on the basis that there is a fixed term to maturity period. Withdrawals and surrender, termination, of the contract may be penalized by the insurer providing the segregated fund contract. The penalty, which is applied in the early months of the contract, is intended to deter clients from making withdrawals and surrendering the contract. Such penalties are applied against the value of the contract and reduce the sum received by the investor. The policy of each insurer states their charges for withdrawals and surrender. 2.3.5 Age restrictions. There are age restrictions for both the last age to establish a contract and the last age at which a deposit can be made. Segregated Funds and Annuities Chapter 2 Segregated Funds 79. A segregated fund in a registered retirement savings plan, RRSP, is bound by the rules that apply to all RRSPs. Therefore, the oldest age at which a contract can begin as an RRSP is 71. Deposits can be made until December 31st of the year in which the contract owner turns 71. Then, the RRSP is converted to a Registered Retirement Income Fund, RRIF. A RRIF account sets the last age for authorized transfer, for instance from a rollover of a spouse's RRIF, at 90. Segregated funds held in non-registered accounts and tax-free savings accounts, TFSAs, also set the maximum issue age limit at 90. There are provincial variations between other types of registered accounts and age limits associated with each. 2. For segregated fund taxation. The taxation of segregated funds is a very complex subject. The following details are an overview. An investor should always seek tax expertise from a tax professional in regard to taxation of his segregated fund account. Agents should seek tax expertise from their in-house professionals or recommend the investor seek independent tax assistance. Taxation of a segregated fund is based on two fundamentals. Black small square whether the account is taxable, e.g. a non-registered account, or registered, such as an RRSP/RRIF/RDSP/LIRA, or non-taxable, e.g. a TFSA. Black small square the form of investment income earned in the fund. 2.4.1 Tax on deposits. Deposits or premiums paid into a non-registered account, or a TFSA for a segregated fund purchase are not tax-deductible. However, they are tax-deductible when paid into a registered account, except when the account is a Registered Education Savings Plan, RESP, or Registered Disability Savings Plan, RDSP. 2.4.2 Tax on allocations. Investment income can be earned in both non-registered and registered accounts as black small square interest, black small square dividends, black small square capital gains or losses, black small square foreign income. In a non-registered account, these forms of investment income are passed from the fund through to the investor. This is the allocation, as was explained earlier in this chapter. The investor receives a tax slip from the insurer and reports the income on his annual tax return. The investor also reports the capital gain or loss on the switch of units and certain other events that occur within the fund. Each type of income is taxed differently. Capital gains and Canadian dividends receive preferential tax treatment. In a registered account, these forms of investment income are allocated to the investor, but they are not reported for annual tax purposes. This is the nature of tax deferral provided by registered plans. 2.4.3 Tax on withdrawals. It is important to remember that the fund may be held in a non-registered or a registered account. Taxation differs significantly between the two accounts both for withdrawals and the guarantees. When units of a non-registered account are redeemed for the purpose of a withdrawal, a capital gain or loss will be incurred. This must be reported on the investor's annual tax return. The amount of gain or loss is based on the adjusted cost base, ACB, of the units and their market value when they are redeemed. When a withdrawal is made from an RRSP or a RRIF, the institution holding the account retains a portion of the withdrawal as an advance against future tax owing. This is called a withholding tax. Even though the investor does not receive 100% of his withdrawal due to the withholding tax, the full amount of the withdrawal must be declared for tax purposes. A reconciliation is made on the investor's annual tax return that takes into account the tax withheld against the tax owing. Tax is applied at the same rate as interest income. The TFSA is an exception in that no tax is declared or paid when a withdrawal is made. When an RRSP matures, at the end of the year in which the account owner turns 71, the account holding the segregated fund can be rolled into a RRIF account. RRIF accounts require a minimum annual withdrawal. The first payment must be received no later than the year after the account was set up. Although tax is typically withheld on withdrawals by the financial institution holding the account, the annual minimum RRIF withdrawal should not be charged the withholding tax. Withdrawals in excess of the minimum are subject to withholding tax. 2.4.4 Tax on maturity guarantee and death benefit guarantee. Tax on the guarantees applies to the top-up sum contributed by the insurer if the market value of the units is less than their guarantees. When the segregated fund is held in a non-registered account, any amount paid as a maturity guarantee or death benefit guarantee top-up is taxable as a capital gain. When the fund is in a registered account, top-ups are taxable as income. A surviving spouse named as the beneficiary of a registered account can defer tax on the top-up if he rolls the proceeds into his RRSP or RRIF. Top-ups for guarantees required for TFSAs are not taxable. It is essential to check with a tax expert about taxation of top-ups. Chapter 3 Annuities. Competency components. Black small square analyze the available products that meet the client's needs. Black small square implement a recommendation adapted to the client's needs and situation. Competency subcomponents. Black small square analyze the types of annuities that meet the client's needs. Black small square propose a recommendation adapted to the client's needs and situation. Segregated funds and annuities. Chapter 3 Annuities 82.